Oi!
Welcome to Trade Ideas. I'm Alex Rosenberg here with Nick Colas, co-founder of DataTrek Research. Nick, thanks for joining us today.
Absolutely.
So today, as we're recording this around midday, S&P up about 1%. Seems to be a pretty good day for the markets. As you look at these moves, today, but over the past few weeks, really, what questions do you think the market is trying to figure out and decide as we see these big vacillations to the upside and the downside?
Well, the biggest issue the last, call it 72 hours, and will be the case for the next day or two, is what is Jay Powell going to say at Jackson Hole? And Fed funds futures clearly think the Fed is going to cut rates by 25 bips at every meeting through the rest of the year. It's a very specific outlook in Fed funds futures, and it's really coalesced around that expectation in the past, call it a week. Before then, people were thinking maybe a 50 some point or not. Now it's very clear, 25, 25, 25. Markets are setting up to want to hear that from Powell on Friday. Trouble is, he's probably not going to say that.
Now, it's interesting because when your colleague Jessica was here 2 weeks ago, she talked about looking for a expectation of a 50 basis point cut at the next meeting as one of the things you would want to see in order to know that the market was bottomed, that it was a dip to buy. So we're not saying that. What does that indicate to you about the path between here and that meeting?
Yeah, exactly right. And it tells me that we're still in for more volatility. I think the market said, okay, 50 is off the table. We get that. That's too extreme. But how about communicating to the market that you're there for the market by cutting rates consistently and not being a one and done or a mid-cycle adjustment the way Powell described it at the July 31st Fed press conference. So markets are shifting, still hoping for some relief from the Fed. But at the same time, hard to believe the Fed's going to go that far out on a limb when things still don't look all that bad, according to the data that they watch.
Now, I'm glad we have you here because you're known, at least to those of us in the financial media community, for finding different ways of looking at what's going on in the economy of, unconventional ways. I think you've looked at burger sales. You've looked at, I think, plasma sales, people selling their own blood. What those, Google searches as well, what do those sort of indicators tell you about where we are, if this is an economy where it's appropriate for the Fed to be continuing to ease?
Yeah, you're right. We look at the standard data, but we also spend a lot of time looking everywhere and anywhere for anything that might give a tell on the economy and find an edge on that topic. And the thing that we look at right now a lot is Google Trends. This is something that any one of your subscribers can do. Just go to Google Trends and you can see how many times a given word is searched for. The two we look at most often right now is the word coupon and the word unemployment. Coupon indicates the beginning of some stress in household budgets, perhaps because somebody's not working as many hours or somebody's lost a job. And unemployment's a good leading indicator of when people begin to fear unemployment. And these were two things that began to tick higher ahead of the last recession, long before the yield curve inverted, long before anybody was talking about it. And it gave a nice about 6-month window where it was ticking higher, where you could say, aha, there's something going wrong. There's something amiss in the U.S. economy. And so far, Google Trends for coupon and unemployment are both rock solid or declining. So again, shows, at least from that level, consumer confidence, we're not yet, clearly going off a cliff.
And we had some retail earnings that surprised the market to the upside as well. So indications about the consumer maybe look a little better now than perhaps a month or 2 months ago.
It does feel that way, and look, it should feel that way. We still do have very low levels of unemployment. We have some wage growth, not what we had in the last cycle, 4% then, 3% now, but still pretty good. Confidence should be good. It'd be really worrisome if you had a lot of big retailers disappoint and miss.
On the other hand, the market signals have been less good. A lot of people learned what the yield curve was over the past week. I was watching the Sunday morning, politics roundtable shows, and hearing people try to explain the yield curve was a little bit painful, I have to say. But as that's come to the fore as a potential indicator of recession, as a signal that's always worked apparently, what do you make of that whole debate about the importance of it this time around?
It's an interesting indicator, and it certainly has somewhat of a track record. But at the same time, my personal view, it is super lazy to just look at the yield curve and say, aha, recession's coming, turn out the lights, sell your stocks, and go home. There's so much more in the economy that matters than just interest rates.
So what are some of the things that we're not looking at as much that perhaps we should?
Yeah, look, the key issue is oil prices, because yes, the yield curve is inverted ahead of every recession since 1973. But if you look at the change in oil prices year over year, over the entire time frame from 1970 to now, you will see that ahead of every recession, every single one, oil prices doubled over the course of a year, and sometimes a lot more. In going into the Saudi embargo in 73, oil prices actually went up by 500%. And then ahead of the Iranian Revolution in 79, same thing. When Iraq invaded Kuwait, same thing. Even in 2007, people kind of forget, but oil prices hit $140 a barrel and had doubled over the course of a year. So it isn't just enough to say, okay, we got the yield curve inverting, therefore recession is inevitable. What we don't have is oil prices doubling. We don't even have oil prices going up, they're going down. If you ask the average person on the street, what's the Fed funds rate? They'd look at you like you have two heads. But if you ask them how much they paid for gasoline last week, they would know down to a nickel, and they would know the general trends. So to my thinking, it isn't just the yield curve. We have to look at fundamental factors as well. Oil prices are just as good an indicator of future recession risk as the yield curve, and I think a lot more explanatory about how consumers really behave.
This is a very hard question, but help us explain the relationship between the shape of the yield curve and oil. Is it not coincidental that the yield curve tends to invert as we see oil prices spike?
Yeah, no, I'll put it this way. An inverted yield curve is like a lot of dry tinder sitting, in a fireplace. And the spike in oil prices is the spark that actually gives us the flame for a recession. So right now, yes, a lot of dry tinder around, and that's where the market's volatile, and rightly so. I don't want to dismiss what's going on, but at the same time, if you want to tie to an actual fundamental issue that matters to everybody, oil prices are the thing to look at, and oil prices simply aren't providing that spark right now.
And it seems to me, at least, that you always hate to say that we can't have a kind of geopolitical event that sends oil prices. You hate to make predictions about this can't happen because it's easier to remember those. But it seems to me that we're just in a different world when it comes to oil, where the Strait of Hormuz is in the headlines again, and yet oil prices don't care, the market doesn't care. It's sort of a geopolitical story rather than an economic story, just because the U.S. Makes so much more oil than it used to. I guess when you look at oil specifically, if that's going to be the oil that lights this fire up, to continue the metaphor, do you see anything that would indicate that oil prices would spike and that would, set this tinder ablaze?
Yeah, look, you've got the right. I think you've got the right sentiment about it, which is you can never say never, and it certainly could happen. And the Middle East has been a geopolitical mess for my entire lifetime, 50 plus years, and I don't think it'll change over the rest of my lifetime. So is there a lot of risk to it? There always will be. But you're right. Oil production in the U.S. has roughly doubled over the past decade. So we have a brand new technology that gives us a better supply. That does at least alleviate the worries about availability, which really is what killed the economy back in 73 and 74. It wasn't just prices, but you couldn't actually buy the stuff. So now we have a better setup. It's not a foolproof setup, but it's a better setup. And the one other thing I'd say is look at energy stocks. Energy stocks, even 5 years ago, were 10% of the S&P. Now they struggle to hold 5%. That group is super beaten up. So in terms of thinking about how you hedge and how you think about risk, one thing you might want to stay long, at least neutral weight, is energy, because then if you do get something bad that happens and the rest of the market pulls in, energy stocks will at least finally start to work. 5% of the S&P, I think, is a record low. I don't think it's ever been lower. And yeah, maybe it goes to 3, but if things do spark up in the Middle East, it goes to 10 again.
If you were concerned, what other sector would you pair against that as a sector to maybe underweight?
Oh, consumer discretionary, tech. Anything at the top of the cap table, basically on the S&P, is going to get whacked. Correlations between the different sectors run heaviest in technology right now and in consumer discretionary. You might also look at staples as defensive, but that's more of a yield play. Energy is that geopolitical hedge. Gold, obviously, should work as well.
It's interesting. We've heard a lot of ideas for hedges recently as people are worried about this chance of a recession, and we've heard about Eurodollar futures and heard about volatility, and gold certainly has come up as well. But going long energy as a way to almost, I've heard of energy as a revenge trade where you sort of go long energy in case your oil prices go up, but as a way to hedge against the broader market is very interesting. So Nick Collis of DataTrek Research, thanks for bringing it to us here at Real Vision.
Thank you.